Good morning, Trinidad and Tobago, and welcome once again to the Bourse Report. Last week on the Bourse Report, we covered equities internationally and looked at what was happening in terms of capital appreciation and returns to you on your US dollars if they were invested internationally. What it did show was that the markets were doing very well, with capital appreciation in Asia being in the order of plus 25%, particularly in India. In Latin America, Brazil, plus 25% in terms of capital appreciation as well, and other areas of Latin America doing much better than even Brazil. And we looked at even the US, and the US was doing close to 14% in terms of capital appreciation on a basket of equities. So good things are happening in the various areas, even in Europe as well. There was a high level of growth. So had you invested in these areas, you would have generated far better returns than what you could have gotten on US money market or even the TT equivalent in US in the local market for equities. Today, we turn our attention to what's happened with the bond market. And we look at about 5 graphs showing what's happened in Trinidad and Tobago situation, as well as what is happening with an international basket of funds measured in US dollars, bond funds that is. So let's go to the first graph. What's been happening in terms of the Trinidad and Tobago situation? Not much change in the 10-year yield since December of 2016 to now, September 2017. 10-year bond would yield you, if you were to buy it now, about 4.38%. Not much change there. We'll look a little later at what's happened with regard to inflation. What's likely to happen with interest rates in that area, particularly for savers and investors? When you look at the next graph, what do you see? You see a situation with regard to liquidity in the Trinidad and Tobago market. That is, the amount of funds in excess out there flopping about looking for a home. And that's about $2.4 billion out of an overall total of about $100 billion in the banking system. What it does say is that it is unlikely that interest rates are going to move significantly with this significant over surplus of liquidity in the system in the near term. What may move it, of course, is the question of credit rating. Our debt to GDP, as we've spoken on many occasions, have moved very significantly, and this is a metric that tells you that credit rating could be adjusted down as it has, as well as the interest rates should or likely to go up in this kind of situation. So let's go now to our third graph, which speaks to the question of what's happening with the 10-year Treasury and what's happened with inflation. Over the past 3 or 4 years, you have seen a situation where no real interest rates were earned. That is, inflation was higher than the interest rate. What we are seeing today, when you look at that red line, which gives you the 10-year Treasury, and the yellow line, which shows you inflation, the difference between that red line and the yellow line, roughly speaking, is suggesting that you are getting a real rate of return if you believe that headline inflation is actually just 1.3%. It's a good story for savers because you don't want to put $1 for the medium term and then find out when you take back that dollar it's worth 80 cents or 90 cents, as the case may be. Once real returns are in order, you should be benefiting from that. Let's now turn to the main item, which what's happening in terms of US dollars. Are you getting enough in terms of your US dollar returns? That is a question that is often being asked. And we have said at Bourse you should go longer and you should expand the range of asset classes that you can invest in your US dollars. In Trinidad and Tobago, the US dollar bank rate is just about 0.1, 0.2%, and money markets are about at the top, 1.5%. What's happening with bonds across the world, which you would have to invest in through US dollars? If you look at the 3-year return, you will see with coupons, you're getting about 11% cumulatively. And what has happened in the first year, over 1 year, 3%. and year to date 7%. So certainly you will be doing better, and this is with hindsight. This is not what we will be looking for going forward, but we'll talk about that later in the year, head into early next year. This was investment grade bonds. And the other point I want to make to you with regard to high yield bonds. And these high yield bonds, if you look at our next graph, are showing even better returns, but also with some higher risks. For the 3 years past, the return was about 27% with coupons, 1 year 8%, as you would see on your screen in green, and year to date 10%. What have we been recommending generally? We are saying to investors that you need to look at, in entering this market, a hold to maturity strategy. And that hold to maturity strategy in investment grade bonds from 5 years to 7 years will give you a range of 4% to 6.5%. Let's discuss some of these things as you look to get your US dollars to work much harder for you at a time when it is very difficult to come by these US dollars. Why have them sitting in the bank at 0.1%? Go out longer, expand your asset classes into international equities and international bonds. And let's see what's going to happen in the year ahead. Look for us with our mutual funds under Save Invest at Bourse and in the newspapers. And listen out to us if you want to get any further information. On your screen, you will see the various areas that you can contact us, our website, bourseinvestment.com, and our telephone numbers. Have yourself a wonderful investment week. This is Subhash Ramkilawan for the Bourse Report.